Welcome back to Explain the Charts, your go-to source for in-depth market analysis. Today, September 25th, 2025, we're taking a deep dive into the EURUSD currency pair, examining both the latest news and the corresponding chart data to uncover key trading insights. The macroeconomic picture heavily favors a strengthening US dollar. Recent data revealed a robust Q2 gross domestic product growth of 3.8% and durable goods orders surged by 2.9% in August, far exceeding expectations. Furthermore, initial jobless claims dropped to 218,000, underscoring the resilience of the American economy. Federal Reserve Chair Jerome Powell has maintained a balanced tone, but the market interprets recent Fed communications as suggesting higher than previously expected stabilized rates, which bolsters the dollar. On the Eurozone side, the narrative is quite different. Germany's producer price index fell by 2.2% year-over-year in August, signaling disinflationary pressures. Adding to this, European central bank officials, like Mario Centeno, have hinted at further rate cuts to address inflation below target, adopting a dovish stance. Political instability in Germany, with snap elections and mass anti-austerity protests in France, introduce a risk premium for euro assets, creating a perfect storm for euro weakness. This strong divergence in economic fundamentals and monetary policy is the primary driver of EURUSD movements. Now, let's turn our attention to the daily chart. Looking at the period from late August to mid-September 2025, we can clearly see a strong bullish trend that culminated in EURUSD hitting a four-year high of 1.19188 on September 17th. This surge was likely fueled by earlier market expectations of more aggressive Fed easing and a weaker dollar, as indicated by news reports from June 2025 that the pair broke 1.17 on Fed rift and dollar collapse. However, the most recent data on September 24th shows a sharp reversal, with the pair closing at 1.17418, down significantly from its peak. This recent downturn directly correlates with the renewed US dollar strength and dovish ECB remarks we just discussed. The decline from the 1.1918 high has been aggressive, with 3 consecutive bearish daily candles leading up to yesterday's close on September 24th. This indicates mounting selling interest, pushing the pair below several short-term moving averages. From a technical perspective, the immediate resistance levels to watch are around 1.1790, which was an intraday high from recent trading, and 1.1820, a level that would need to be reclaimed to ignite any bullish momentum. On the downside, key support levels from the news and our charts are converging around 1.1710 to 1.1700, followed by the September 11th low near 1.1660. A break below these levels could signal further acceleration of the bearish trend. Shifting to the 1-hour chart, let's zoom in on the price action from September 8th to September 10th to see more granular movements. Here, we observe relatively tight consolidation followed by an attempt at a breakout, but ultimately a failure to sustain higher levels. This reflects the underlying uncertainty before the recent decisive move downwards. The increased volume during the periods of significant price moves, especially on bearish candles, confirms the strength of selling pressure in the market. Looking at the latest 15-minute chart data available, up until the end of September 24th, we see consolidation around the 1.174 level. However, news reports today, September 25th, state that EURUSD is now hovering around 1.1670, marking new 2-week lows. This suggests a significant bearish gap or continued decline since our last recorded candle. For intraday traders, this immediate price level of 1.1670 becomes a critical support. If it holds, we might see a slight bounce, but if it breaks, further downside towards 1.1650 and 1.1615 is highly probable. The overall momentum on these shorter time frames remains strongly bearish, with rallies likely serving as selling opportunities. So, what are the reasons to be bullish or bearish? The bullish case is currently weak. It would require a sudden economic recovery in the Eurozone or an unexpected dovish pivot from the Fed, perhaps due to weakening U.S. data. This scenario is less likely in the short term, given the current strong U.S. economic indicators and the Fed's stance. The bearish outlook is considerably stronger. The robust U.S. economic performance, coupled with a hawkish Fed, and the disinflationary pressures and political turmoil in the Eurozone, are strong fundamental tailwinds for the U.S. dollar. FexStreet's chief analyst even forecasts a potential return to parity at 1.0000 for EURUSD throughout 2025, which would represent a significant long-term depreciation for the euro. For traders, consider selling rallies as long as the price remains below the 1.1820 resistance level. A break above this could invalidate the immediate bearish bias. Immediate short-term support is at 1.1670, followed by 1.1650 and 1.1615. On the upside, 1.1740 acts as intraday resistance, then 1.1785 and the more significant 1.1820. Long-term, if the bearish trend continues, we could see a test of the 1.1200 psychological level and potentially the 1.0330 zone as discussed in the longer-term forecasts. Watch out for upcoming U.S. economic data, particularly inflation reports and further statements from Fed and ECB officials, as these will dictate the next moves. To recap, EURUSD currently faces strong bearish headwinds. Important price levels to monitor include the immediate support at 1.1670, then 1.1650 and 1.1615. On the resistance side, 1.1740 and 1.1820 are critical thresholds. Our unbiased prediction for the short term is a continuation of the bearish trend, with a high likelihood of testing the 1.1650 to 1.1590 range, reinforced by continued strong U.S. economic data and dovish ECB rhetoric. Long-term, the potential for a move towards 1.1200 and even parity by end of 2025 has a moderate to high likelihood if current macroeconomic trends persist. Traders should look for confirmation signals like sustained breaks of key support levels on higher volume or failed attempts to rally above resistance, which would further reinforce the bearish outlook. Thank you for joining us on Explain the Charts, and remember to always trade responsibly.